Is it time for another one of these videos? Well, apparently it is. Are we in for a wild ride of a Bitcoin bounce? Are we looking at a V-shaped recovery, as tons of talking heads are saying now? Or is there more dumperoo on the way for crypto and traditional markets in general? Well, if you look at the actual information that moves the markets, right, the VEPs, then you'll know that the indications for today, for example, offer a nice mixed bag for low time frame scalps. Right? Got plenty of movements to the upside, the downside. So it does not matter what the big picture says in the sense of running low time frame scalps. If you're looking at higher time frames, well, there certainly are indications that today is a bit of a flat day or even a bit of a down day for some assets. Bitcoin looking relatively flat for the day so far compared to like yesterday, right? Or last week. But does that mean it's going to stay flat? Well, of course not. That's why we look at lower time frames, right? To see the actual changes happening as they do, starting on the lower time frames and building up into higher time frames. There was still, last time I looked, some minutes ago, a trending move to the upside for the day overall. And what does that mean? Well, that means that the asset's in a trending move on the daily candle. But that does not mean that that has to stay that way, right? Information is dynamic, it changes. And again, it starts from the lower time frames. That's why trading, is generally best managed on lower time frames, even if you manage to get into a trade on a low time frame and stay in it for a relatively longer period of time until it stays or gets into a higher time frame. Right, say you enter on the 1 minute or the 3 minute, and it builds up into a nice trade even on the 15 minutes, and then you can possibly have good reason to stay in that trade, monitoring the 15 minute as the principal time frame of trading interest. That does happen, of course. That is kind of the point of using a system like the VEPs. Obviously, if you're running a high frequency trading algorithm, as they do at huge firms like Citadel, etc., then obviously they, run many trades per second, or millions of trades per second using incredibly powerful computers, which does not mean that you can do that, right? Unless you have some kind of connection in one of those firms, or you work in one of those firms, or somehow have access to that kind of computing power and staff and everything else required to run that kind of programming, then the probability is that you should be running higher time frame trades, like 1 minute or above, or whatever you're capable of actually managing. Right? There are people who'd like to do 20-second trades, 30-second trades, 15-second trades. I get it, but generally speaking, unless you're incredibly fast and have a great internet connection and a decent position size, 15 seconds, 20 seconds, even 30 seconds can be, quite hectic and not necessarily lead to better percentage gains in terms of your returns on any given trading session. So it can actually be counterproductive to try to trade those super low time frames manually, when instead you could just, run those trades more effectively by starting out at like a 1 minute, letting the trade hopefully build up to a good 3 minute or 6 minute time frame. Very often I find that 1 minute trades are good to take profit on at around 7 minutes, sometimes 15 minutes. It's not a pattern. I'm just saying on average, it's not a pattern. It's just an average, right? If I'm running 1 minute trades, they'll typically last about 7 to 15 minutes tops. And from there, take the profit and then rinse and repeat on the next occurrence of opportunity. That does not mean I immediately flip the position as soon as I take profit. Right? There are many cases where I take profit and then I just let it ride until I see the next actual occurrence of opportunity, right? Because just because an occurrence of opportunity has happened and I've entered the trade and then taken profit on it, does not mean that the very next moment there's going to be an occurrence of opportunity to the opposite direction, right? It could be that it just cools off for a couple of minutes and then starts again in the same direction, in which case I enter the trade in that direction again, right? But the reason I got out of the trade in the first place is because I saw the returns were diminishing, right? The volatility had maxed out or bottomed out or whatever. Correlation, same thing. And it was starting to go a little sideways, right? On variance, same thing, or on entropy or whatever. So that was, indicating to me this is a good area to take profit, right? And of course, if you have like a massive burst in one way or the other, those are also good places to take profits. If you crush, 4, 5, 6 standard deviations or Laplace distribution points, which does happen, those are usually good areas to take profit too, even if it continues, right? Just because if it makes such a big move, there's a very high likelihood that it could go the other way and you just as quickly, at least taking back a significant chunk of your profit, right? So that's why, first of all, that's why it's best to look at low time frames for actual occurrences of opportunities to make entries and exits, and let the system of using the VEPs, help you build up the length of your trades in terms of duration, only as long as it's actually profitable to do so. Right? When you see periods of cooling off in terms of motion, those are generally good places to take profit and reset. Even if you, could hang on and make more by a little bit just by not getting out of the position. It doesn't matter. What matters is being consistently profitable with each trade, right? And the more you do trades, the more you trade, the more number of trades you trade consistently profitably, right? And the better it is overall for your P&L and your skill at actually repeating that, as opposed to just trying to do like one trade a day or something and holding on for dear life. That's, it's a very risky way to manage your risk. So overall, is the market going up, down, or sideways? Yes, the market is going up, down, and sideways, because it's all assets ever do is they distribute away from the means and then they mean revert, and price action just follows. So if you want to learn more about how to do that, check out the live stream starting at 9 a.m. Eastern time. Just go to alphatradinghq.com/discord and you can enter for free and enter the live stream. Okay, see you guys. Happy trading.